One sec.
Excellent.
Recording in progress.
Alrighty, so welcome everyone to DSAI's inaugural Quant Finance talk. I think it's going to be a lot of fun. Thank you to everyone who's going to be joining us. Yeah, that's good. And thank you to everyone who's going to be watching the recording. I think you guys are going to have a lot of fun. We have a lot of interesting topics to cover. And we have the famous Berowne joining us for a Q&A a bit later. We're going to start with a short interview with our co-presidents, Mark and Arturo. Mark, congratulations, first of all, on your new co-presidency along with Arturo. What made you guys want to join DSAI? I'll go to Mark first. You're on mute. Oh, no.
Okay. That's okay. There we go. We figured it out. The guys at DSAI had been around since 2019, and we'd gotten to know those guys through my work at the ASX. We had one of the interns working at DSAI working with us at ASX and told us all about this kind of stuff, and we wanted to sponsor and potentially get some people to work with us at the ASX out of DSAI. And we went to that first event, 200 plus people over at Amazon. Back
yeah,
when
that's right. That's where I met you, actually.
Yeah, exactly. So the good old days when we could like all meet up in person, and we were going to do that in person with this one until you know, COVID recently hit. But basically we wanted to initially, Arturo and I, we'd worked together overseas in London, and we wanted to do something for the data community given our backgrounds and seeing how we can help. And what we found was that you know, we'd want to do as speakers, but then, you know, with COVID going on, it was really hard to you know, kind of do anything. So we thought, well, why don't we get involved and try to help out with the volunteering? And so we did a little bit of that initially, and Jackie and Paul and Shuning, who started this, asked us to basically see if we would be interested in helping to run everything. So we basically signed up, and we see it as there's three things that we really wanted to take care of here. The guys did a lot of great work. There were Tesla live events, there were events at Microsoft, there were events all over the place, and some great speeches and talks. And James, you did one of those, so that was really good.
Yeah, that's right. I actually, I remember the Tesla event. That was quite great. We had so many talks on the different AI methodologies that go into a potential, you know, Tesla vision, and the trade-off between accuracy and speed, and where Tesla kind of draws a line. That was great. Yeah.
And yeah, so that's basically it. And we wanted to, you know, see what we could do to help people that are just getting started. So we've got an aim to help those people. We've also got an aim to help those that are a bit more advanced. So people such as yourself, James, Berowne as well, if there's anything that we can do to help you guys out too. And then a line into businesses. So that's why we're looking at running hackathons. So if anyone's interested in that kind of stuff, you know, it's not just finance focused, it might be sustainability, and other types of things there in that space. But look, I'll jump to Arturo now, who's going to show us a bit of a presentation. You should be able to share your screen, Arturo, about, you know, what is quant finance. So we've just prepared a short little thing before we intro to Berowne and looking at the great things that he's doing in the NLP space. So James and Arturo, I'll leave it over to you guys.
Thank you. Sure. I just noticed that I'm going to have to restart my Zoom connection to do the share screen.
Okay. Okay.
So Mark,
why is that?
Give me a second.
I'll just keep talking. It's what I'm good at.
Yeah. I was going to say, Mark, just while Arturo is loading that up, what's your vision for DSAI? I guess in a Twitter post. Well, where do you want to take this organization?
Well, we want to become an industry body. Is the big thing there, and we're still many steps away from that, but we've got a good followership on Meetup. Here we go. Arturo, are you there?
I'm good. Yeah, I'm good. I didn't need to. I didn't need to restart.
We can talk about the vision later.
All right. So yeah. So Arturo, what's this? What's OpenInsight?
Well, OpenInsight is it's a group of various individuals that are specialists in different areas, but mostly focus on delivery of data solutions. So I wanted to talk a little bit about not specifically what OpenInsight is, but more about quant finance and not knowing exactly who is part of this chat, and knowing that Berowne is going to talk about something that's really, really interesting. I wanted to give the beginners, if there are any, a bit of a view of what quant finance is and kind of how it started. Now, I started out as a quant initially in London, where I spent 13 years building various types of models. And I spent most of my career there building derivative pricing models. I found that really, really interesting. And that was, that was some time ago, but it does give you a certain understanding of the application of mathematical models, and also the understanding of how you infer or interpret reality using these models. Something that is called data science now, but we were kind of doing it as quants for a pretty long time before. So first of all, keeping it really, really short here, I just wanted to give a very brief understanding of what risk actually is. And that's actually a really, really important thing. Now, from my point of view, risk is actually just the potential of negative impact based on a current decision. And the important thing here is the key word, which is potential, meaning that risk is something that is only related to the future. And if it has happened historically, it's not a risk anymore, it's a realization. And many people actually miss that detail unless they've been playing around with this for quite a while. And that has pretty deep implications on the inference of what the models are actually telling you and how you fit them and all that kind of stuff. Now, typically in quant finance, there are 4 different areas: derivatives, portfolio optimization, risk management, and pattern recognition. Now, please jump in if you believe that there are more areas, but I'm just trying to keep it simple here. Now, derivatives is really, really interesting. They're all quite different also in nature, those 4 areas. Derivatives is more of a physics-based type of approach where you kind of have an idea of how you're supposed to price an asset. And based on its relation to other assets, you actually infer, or you generate formulas, closed form formulas called the Black-Scholes formulas. And they are very, very mechanical. Like there's not much statistics going on here. Now we go into portfolio theory, which is really just about the optimization of how you hold your assets in a portfolio. And the issue here is really that you're trying to find good ways of diversification through choosing the right weights to enhance your risk-adjusted returns. Now, one really interesting anecdote here is that when you're looking at the risk in terms of portfolio theory, you're not looking actually at the volatility of the asset, but you're actually looking at the potential risk of you getting your expectation of the asset wrong, which is not necessarily the same thing. Now, one way of looking at that is, imagine if you're actually investing with 2 different people, one of them that is a really good oil trader, and the other one which is a really, really bad fixed income trader. Now, if you're trying to create a portfolio optimization model of this thing, your risk to the good oil trader is actually going to be lower than your risk to the really bad fixed income trader, because the oil trader is probably going to get it right. Now, that's again, that's another interesting anecdote that needs to be taken into account in the models, and it'll have implications for a few things that I'm going to talk about later on. Now, risk management, which is a really, really big field. Here, it's really about estimating the risks of a portfolio, and we're talking about tail risks. Now, the issue with this is that tail events just don't happen particularly often, and they just don't repeat themselves, which is why many of the current or the new methodologies that are being used are so interesting. And I'll touch upon those soon. And then finally, we get into pattern recognition, which effectively is technical analysis and regressions. Now, an interesting anecdote here is that the word on the street, at least, is that technical analysis actually came out of Japan when Western traders were trying to trade Japanese equities but couldn't read the news. So they had to find a way in which they could actually make sense of all of the numbers and the reality of the markets. Now, if it's true or not, I'm not sure, but it kind of makes sense. Now, from a math point of view or statistics point of view, the big problem with pattern recognition in finance is that markets are very, very heteroscedastic and they're non-stationary, which means that once you find a pattern, that pattern is probably not going to live for much longer. And once you find the reason why this happens is because the market kind of identifies that there is an inefficiency in the market, and then others will come into it and they'll erode that inefficiency, and all of a sudden, you can't exploit it anymore, which is also another area where you can start using new tools to get better results. Which is what I'm going to talk about now, which is the machine learning part and the future directions, as I would see them. Now, we can't really talk about future directions without first acknowledging the big change that has happened, I would say, in the past 5 years, with the incoming of alternative data and the ability of this data to offer orthogonal explanatory power to the data sets, which is really, really important. Second of all is cloud computing, because back in the day, it would only be the funds with a lot of budget that had the ability to create these large experiments and big simulations, effectively the people that had the money to buy the big computers. And now that's been democratized, which makes it a lot easier. And second, and lastly, but not less important, it's the availability of models, where you don't actually have to write all of your neural networks. You don't have to write all of your tools. You could just use open source tools and play around with them, meaning that as long as you have a good understanding of the data sets of what you're doing and a relatively good understanding of the output of these models, then you can actually start playing around with them. And that makes a massive, massive difference in terms of workflow. Now, for those that are interested, I know that this is a bit of a quick presentation because I just want to jump into what Berowne is going to speak about. Now, in terms of derivatives, neural networks have been used really in a really interesting way. And it's that we're currently using neural networks to speed up the computation time it typically takes to both calibrate option surfaces and price these options. Now, typically, what would happen is that you'd have a workflow whereby you'd have to take in all of the option prices from the market. You'd have to translate them to implied volatilities. Then you'd have to calibrate your curves to these implied volatilities and use that data to price, which on its own is a computationally intensive process, and then calculate the Greeks. Now, we're using neural networks to effectively integrate that entire process into one computation, which makes it much, much quicker. Now, that's a big thing, because I remember when I was in RBS, and this was in the beginning of 2007, would effectively have big data farms internally within the bank just for these types of computations. And it's a really, really expensive process. Now, second of all, we have classification algorithms. And I think that one of the big problems with portfolio optimization specifically is that A, it's difficult to know what is going to, what the future expectations of the assets are. But B, it's actually more fundamental, and it's finding stable correlation matrices. Now, correlations are really difficult because it's like a second derivative that you're trying to sample, and they're very spurious. They move all over the place. Now, with classification algorithms, we've actually been able to find more structural relationships and effectively build classes of these different assets that we're playing with, and therefore use this information to apply hard constraints on the portfolio optimization, whereby making the correlation estimation less important. I mean, it's still important, but it's not as critical as it was before. And finally, something that's really interesting is that for extreme events, so we were talking about risk management, and the point that I was making before, that the rare events don't happen often, i.e. they're rare and they don't repeat themselves. It's very difficult to simulate based on them, or rather based on the history. So now I see people using GANs, for example, where they fit on very small amounts of data, and then they start generating, they start simulating new probability distributions that can be used in order to assess potential risks for portfolios. So it's really a fascinating field to be in right now, because it's going everywhere. And I know that Berowne is going to talk about something else that I haven't really touched upon, because I've only touched upon the numbers. He's going to touch upon the words and how those help the investment community. So over to you.
That was fantastic, Arturo. Thank you so much for that presentation. I guess in the interest of time, we'll get right to Berowne. Berowne, thank you so much again for joining us. And thank you so much in advance for sharing all of your expertise. I guess I'll ask you this one thing. Given you're an NLP expert, I remember back in the day when NLP was first introduced, and people were talking about chatbots on the internet, about, you go to a retailer's website and they say, "Hi, what would you like?" And then you type in t-shirts and they redirect you to the number where you can, call someone about t-shirts, or redirect you to the link where you can buy t-shirts. I suppose a lot has changed since, some years ago when we came up with our first generation of chatbots. Are you able to summarize, I guess, where we are today?
First, I have to unmute.
Yeah.
Of course, thanks, James. Look, the chatbots are still there. Thankfully, they're getting a bit smarter and not directing you to the sock aisle when you ask for t-shirts and so on. Not as much anyway. But yeah, NLP has come, a very long way. I've got a couple of pictures that I wouldn't mind sharing, just to show you a little bit of an example of what I'm talking about. So
Go ahead.
I'll bring that up.
Nothing's coming through.
But yeah, it's like, back 30, 40 years ago when machines were first put towards the task of natural language processing, the idea was to feed in a sentence down the page and just put a 1 in the corresponding column where that word was in the sentence. And this method was cheap. It, needed a small array of integers to work, or booleans even, but it wasn't very clever because there was no relationship between neighboring words. And we've seen people still using bag of words approaches. It's like a term frequency thing as well, where you count the number of occurrences of those words and divide them by the totals and so on. There's been cases of bag of words working, but it's a relatively simple approach, and it doesn't deal with negatives, let alone double negatives, and doesn't deal with synonyms and missed words and so on at all well. And then about 2013, Google came out with Word2Vec, and I think of that as like a PCA for language. It tries to interpret language in high dimensional vector space, but you don't know what those vectors are. One of them might be hardware, one of them might be software, one of them might be country. But if you plot them in a 3-dimensional or 400-dimensional space, you can start to see that neighboring topics and neighboring words and concepts bear some relationship. So the examples that Google published when they put the paper out was capital cities and countries all had a similar vector direction between each point. And you can do some interesting things like mathematics on words. So you can take Samsung minus Android plus iOS, and you end up somewhere around this space, which happens to have Apple at the center of it. So Word2Vec was a good invention, but a lot's happened since then. And we're starting to see some of the fruits of that come through with some of the more modern techniques.
Yeah, I've noticed that there are more and more articles coming out that have been written by NLP algorithms, such as sports articles, where it's relatively easy. I mean, back in the day, you could definitely tell, not passing the Turing test. You could definitely tell what was written by a machine and what wasn't. But I think in today's technology, it's definitely getting more and more difficult. I'll share with you that my wife used to be a reporter for The Australian. And one of her jobs was the afternoon stock report. And she said, look, journalism is actually quite easy. There is a word for, you know, a 3 to 4% gain. There is a word for an over 4% gain. There is a word for an over 5% gain, kind of thing. And I was like, oh my goodness, I can write you an algorithm that can do your job for you. He goes, James, please don't, because I need my job. Anyway, that's the dark side of these NLP algorithms. But
exactly. I've written the same things in Excel.
Yeah, exactly. That's what I said. I said I can write you a spreadsheet. Anyway, so with the NLP technologies getting more and more advanced, what in your opinion is driving all these advances? Do you think it's the need for chatbots? Do you think it's the need to automate human interaction in shopping, or where do you think the industry is headed?
Where do you start? I think what is driving it is definitely the technology corporations, Google, Facebook, Microsoft, etc. They're all competing against each other to publish the fastest and biggest models and the best NLP engines and so on. And the complexity of these models, if you measure the number of neurons in each of the models and their parameters, if you count all the parameters, GPT-3, mind-boggling 176 billion parameters in their model. The thing takes 5 days to train, requiring a whole server room full of clustered computers. It's a behemoth. It's got more parameters than the human brain has neurons, but then each neuron has maybe 10,000 connections, which you can liken to a parameter. So, humans are still vastly more complex than GPT-3, but maybe if they keep multiplying by 10 every year, maybe by GPT-8 they'll be up to the level of a human. Competition's driving it, but also the open source nature. One thing that I'm quite enjoying is the fact that almost all of these models, except GPT-3, are generally being released as open source packages with open source archive documents that explain what the model's doing and compare its performance. And so this competition between Google and Microsoft and OpenAI and independent researchers is really fueling innovation in the space. Like MPNet here, taking some BERT style ideas, mixing them with some XLNet ideas and coming up with a model that beats both of them. That's pure academic research at its best. I think that's really helping.
Quick question, Berowne. I was
Sorry,
actually wondering
sure.
something here. I tried to get into NLP for trading back in the day when I was doing oil. And it was really difficult. I found it because you effectively want to get into a straight feed into, for example, Twitter, because funnily enough, when you're actually trading, you don't really know what's happening in the market. You figure out what has happened after a while, right? But the problem with the text in the way that people write it is that it's so contextual, and there are so many different nuances that can change the meaning of the sentence so dramatically. For example, if it's meant that it's a joke and or they're using sarcasm, how is NLP managing that now, would you say?
That's a really good question. Scale. The biggest single answer is scale. The corpus of text that these models are processing to build their understanding is truly phenomenal. Google, I don't know if you remember, about 10, maybe even more years ago, 15, Google got in a bit of trouble for scanning books without paying copyright. And all the publishers were jumping up and down at them, and they got away with it. They now have almost every published book in an archive that you can download and train your natural language processing models on. They've captured all of Wikipedia, and there's a downloadable summary of Wikipedia articles that you can train on. All the text from certain newspapers for a certain period has been downloaded. All the text from the United Nations with all of the translations from all the transcripts is available. So these single language models are now morphing into multilingual models. And some of those models that do translation are actually performing better than the single language models, even when tasked with single language questions and answers and so on. So in one respect, the scale of the language corpus that these models are trained on is making them more accurate. The size and the engineering that goes into the networks is also helping. But you do raise one of the flaws that in a finance context, we often deal with terms that are a little bit different to what the community talks about. So overweight in the community will often be talking and referring to someone who's a bit obese and has a negative connotation, whereas in stocks and so on, it's obviously a positive connotation. So sometimes you might need to fine tune your model to shift the performance of overweight from a negative connotation zone to a positive connotation zone. And the other ones, phrases that we use, free cash flow, EBITDA, all these types of terms probably do not get encoded properly. The three words for free cash flow on their own have a very different meaning to free cash flow as a financial concept. So the natural language models that are available are amazing. They're bigger and better than you could build yourself, most likely, but they still need to be fine-tuned. And thankfully, the tools are available to do that. And you don't need too much data to do the fine-tuning. Hopefully that answers your question.
I remember Berowne, I was reading an article put out by OpenAI talking about NLP and sarcasm, saying, I love this jumper, it's disgusting, and I love this jumper, it's disgusting. It's like, how do you know which sentiment is better than the other? And retailers are forever, and I'm not sure if this has been solved yet, but retailers are forever trying to decipher, comments with NLP, but the human language has, excuse me, so many nuances that you could spend your entire life training a model and you still won't get there.
Yeah, well, how many times do people in TV shows miss the sarcasm?
Exactly.
When their grumpy boss says something to them straight faced and they take it the wrong way. Like, humans struggle with sarcasm too, and especially cross-cultural sarcasm, where someone in America might not get some British sarcasm or something like that.
A little niggling thing that I noticed in your slide deck, a lot of childish names for these kind of state-of-the-art algorithms like Bert and Elmo. Of course, GPT-3, I probably wouldn't call my child that, but you can appreciate there's some interesting names out there. Why is that? Is there a reason for that?
I've been thinking about this. It all started with Elmo, I think. Back around 2015, if memory serves. Elmo was embedding language model, MO model, that started it, and then Bert came out after that, and all these Muppet characters and Sesame Street characters and so on. But if you think about how they're trained and how you train a toddler to speak or write a language, you cover up a word in a book and say, what's the missing word? And the child has to guess. You're training them like toddlers, like they're playing with toys. So the NLP models are named after characters that, were romping around Sesame Street and helping kids learn English or other languages. So I think that's partly what it's for.
Currently in the process of training a toddler how to speak, my 18-month-old son. I can totally sympathize. My background is Russian, and I'm trying to teach him the Russian word for lots of things, and the first one that he learned was the one for dog. And I say, for example, leaves, he knows how to say in English, but then I say, oh, what is it in Russian? And he gives me the name for dog in Russian. I assume a NLP algorithm might make the same mistake, not trained properly.
For sure. Yeah. And once the joke started, everybody else kept jumping on the bandwagon and came up with equally silly names, except Microsoft.
So going on to finance, Arturo mentioned that there's some interest in analyzing sentiment on Twitter. I know when I was trading bonds in a proprietary desk, we had a tweet deck up right next to the Bloomberg. And I thought, this is the silliest thing I can ever imagine. But we need it there because as soon as someone said some danger words, then the fixed income market would spiral out of control. So why do you think, I guess, other than analyzing Twitter sentiment, if there is any other reason, why do you think financiers and portfolio managers are interested in NLP?
Well, we surveyed our clients at one of our Quant conferences in Hong Kong a couple of years ago, back in the day when you could have conferences personally attended. And nearly 55% said that they were using or interested in using NLP as their preferred machine learning technique. Because you think about quantitative finance, the word quantitative means numbers-based, numerically based. And so one of the things that we're missing in a quantitative portfolio is the written spoken word. So that means, and that is why NLP has become such a popular tool to use in that space. It's kind of filling a gap. If you are looking to Bloomberg to get the company statements right after an earnings result, it's going to take them an hour or so to process that from the published document and turn it into a spreadsheet. But while they're doing that, they might be speaking about the result at a live conference. And if you can turn that into text and analyze what they're saying in real time, then maybe you'll have an advantage. You don't have to wait for the vendors to turn the data that's being presented into numbers and upload your model and miss the opportunity. So there's a certain aspect of immediacy that comes from capturing live data like Twitter feeds or press releases or other news sources that come out live. Not to say it's easy. Twitter try and charge quite a bit for corporate access. They are fairly diligent at stopping bots from accessing their platform and so on. So we've got a fire hose solution that we can use to download millions of tweets, but it's fairly expensive. So we're not using that in our research at the moment, but we are looking at news feeds from the likes of LexisNexis and so on, and trying to explore opportunities and so on about that.
I think that one extra thing there with regards to that question is that a very good example of the importance of Twitter when managing a book, was during 2016 when you'd have the Trump and Putin wars that would effectively change the entire macroeconomic landscape 2 times a week. And reacting to those extremely quickly was very, very important, because your portfolio would turn upside down, literally from just a few words that came out from one of these individuals. It was quite fascinating, and it was impossible to trade because there were no real patterns there, but just the ability to de-risk quite quickly under those circumstances was good enough. So yeah, a lot of the market information actually comes out through these channels. It comes out quicker through those channels than it does through the actual price action. So price action is always going to be reactive versus Twitter that could actually lead amongst all of that noise that comes out.
Yeah, I've seen a few studies that use Twitter effectively, and like Arturo said, I think if you were looking at Trump's tweets and so on, for a signal, it's hard to backtest that kind of thing. So you really do need to build a model with a lot of human expertise and oversight to it. So you really need to understand the machine learning code that you're writing when you do that type of thing. But I do agree that there was definitely an opportunity for that 4-year period. And in terms of Twitter feeds, yeah, we've seen our stock analysts use Twitter to measure the number of tweets and the content, like the sentiment of the tweets around company game releases. So, you know, Sony versus Xbox versus Nintendo, measure all the games as they get released and the chat that goes around them, and see what hype there is relative to expectation and so on. And using that, you're able to get a gauge of potential sales before they publish their numbers and so on. So, you know, there's definitely edges to be had with services like Twitter and other news feeds, but you know, it's not a free signal.
Would you say that you have to train the models differently depending on the feed? So if you're targeting Reddit, for example, versus Twitter?
Not so much sure about that level of difference, but potentially you would. I heard from a few of the vendors that they have different models depending on the source. So they might have a different model for transcripts and earnings calls than they do for the news in general. And then they most likely have a different model for social media. Whether you need a different model for Twitter versus Reddit, I'm not sure. I haven't made that investigation, but there is a BERT model designed for Twitter. There's an emoji BERT model as well. So yeah, these tools are available.
How do you check or validate the quality of the model once you've actually done that calibration?
That's a good question. I'll pull up some slides that kind of help answer that type of thing for our exercise where we looked at sentiment. So we used Hugging Face, and Hugging Face have done an amazing job at bringing all of the Muppets and Sesame Street characters and the Transformers over into one consistent framework, and it works like scikit-learn. You import pandas to load your data, and then from the Transformers package, you import a tokenizer, which does the bag of words and attention tagging that you need, and one of the model types, and we use the sequence classification model. You initialize the tokenizer, and then the model, and then you call model.fit and model.predict. And it's that easy to use. So really a fan of what Hugging Face have done. But to your question, what do you feed it in the training data? And that is key. So some of you will have heard about Phrasebank. Phrasebank released, I think it's about 8,000 or 9,000 headlines with sentiment tags tagged by up to 5 people, I think it was, and looking for higher levels of agreement. So the biggest data set has 50% agreement. The smaller data set is 100% agreement. So depending on how accurate you want to be, you pick and choose your filters. But they've already pre-processed this text to fit in with historical NLP pipelines that needed lowercase words and plurals separated and all the numbers removed. At JP Morgan, a couple of the guys worked on building a 4,000 headline sentiment data set where they didn't do any pre-processing. They just passed these headlines to 2 people to get a sentiment label. And then if they disagreed, a 3rd person broke the tie. There's about 80% agreement with the humans. And so what I did when I used the Hugging Face model was I split that data into a training and a test set. About 4,000 in the training, about 800 in the test set. I ran all the models on the training set, and then I tested them, got the results, and then for out of sample verification, I fed in the Phrasebank set as well. Made some allowance for the lack of a mixed labeling here. And then I took the average score of the test set and the validation set. And I was quite surprised, like the humans were about 80% accurate and about 10 of the models were at that level as well. So they worked quite well, at human level or potentially even higher. And then, once I'd taken those results, I fed it 100 news headlines and had a look at the results from those predictions by hand and agreed. I didn't find any that I disagreed with strongly. And I also had a look at some of the headlines where the humans had labeled them something and none of the machines agreed. And some of those kind of shake your head, or maybe you could make a case for both sides of the coin, or maybe it depends on who's the target of the of the sentence. Like this one here, France's economy minister Emmanuel Macron will have to pay back taxes after authorities found he'd underpaid. And that was flagged as neutral. Well, it's neutral from the point of view of the market. It's probably quite negative for Macron himself. And so it really depends on which entity you latch onto and apply the sentiment to. So sometimes it's quite subtle as to how you measure efficacy.
And are you able to say anything about creating actual trading strategies with the back tests based off signals generated by these models?
I haven't run any on these models that I've tested here. This was just a pure horse race to see which one was more accurate than the other at labeled data, but not in portfolio performance concepts. But that's something I'm very interested in looking into for sure.
We've had a few questions come through from the audience and notes. James, you want to go through some of those? Can you see that in the chat?
Yeah, sure, I can. I'm gonna go with Ina's question. Where is it? Oh no, I've lost it. Oh, that's right. With recent penny stock trading, should Reddit be given more significance in market monitoring?
I'm going to put my corporate hat on and say yes. Yeah, we've had a look at that. Our US team has had a look at that and found some interesting signals from the retail. And they're using almost technical signals to infer the Reddit signals rather than pure NLP. But yeah, I think definitely the retail end of the scheme is playing a part in manipulating or influencing markets, shall we say. And it's a bit ridiculous too. When GameStop was running hard, there happened to be a stock listed on the ASX with a GME ticker, and it was going ballistic too.
I guess it's also possible to kind of overtrain the model, given recent cryptocurrency markets where the coins pop up one day and then they fall down the next, but in between there's thousands of percentage points in between going both up and down. So I guess penny stock could also equal penny cryptocurrency tokens in the same, I guess, token of what we're talking about. Another interesting question from Richard. So the trading opportunity is their brief. In keeping with other comments that these market inefficiencies are very transient, has the Twitter feed now been traded away?
I haven't measured it, so I'm not sure. Like I said, Twitter are quite aggressive in their protection of their valuable data sets. So you can end up paying millions of dollars a year to get all of the Twitter feeds that mention stock codes. And so we're not doing that at the moment, but some people are, and I'm sure they're arbitraging as heavily as they can.
And what about for aspiring NLP experts? What would you recommend the future generation, what kind of path do you recommend they take if they wish to follow your shoes, or become the next generation of NLP experts?
You have to stay current. We spent 3 years building a pipeline to kind of identify thematic portfolios using NLP. And in April this year, Hugging Face released a package that does exactly that in a distributed, clustered environment. I was like, well, there goes 3 years work. We'll just turn this on, and it's been a 3-week journey. It is phenomenal just how fast this space is moving. You have to stay current if you want to stay on top of the current space and not waste years of your time. So read a lot of blogs and posts about state-of-the-art NLP and so on. Despite the silly names, it's not a childish enterprise. And we put out a 6-monthly report for our clients that hopefully some of the audience get access to, that goes through it in detail. So every 6 months I try and review what has happened in the ML space, commonly referred to as AI. We've had to copy that and put it on our cover pages as well. But we're getting closer and closer to AI. So if you're a client, keep in touch with these publications. If you're not, keep in touch on LinkedIn. Have a look at all of the blog posts. Medium has historically had some good articles. Now it's become a little bit of a vacuum that sucks in good and bad. It takes a bit of effort to keep weeding out some of the articles, but keeping up to date is probably the biggest thing you can do. Have a look through some of the historical developments as well, so you get an understanding of where we have been and some of the issues that are being played through. I think that can help your understanding as well.
So I guess that also includes a given that you can't get too emotionally attached to either your model or your work, because you may get a Hugging Face version 2 come in and just roll over the top of it, and you have to be nimble. I guess it's something that I learned in my data science career, that a corporation or even as small as your team could pivot priorities, and you have to just stop, drop and roll and move on to the next. So I guess that also applies here. We've got another couple of questions, if you don't mind, Berowne. John's asking, how will NLP work with Instagram, TikTok, and emojis as communication, as the type word is replaced by human expression? I know we spoke briefly about the algorithm that you spoke about, which can digest emojis as well as spoken word. Do you think that will become more and more popular?
Yeah, I suppose it will, for special content. So, there is an emoji version of Bert, and there's a Twitter version of Bert. It's been pre-packaged so that you can maybe exploit some of the lessons that the engineers worked on that built them. But there are other models that don't even need words. There's a couple of NLP packages on Hugging Face as well that use audio wave sequences to embed a neural net and learn natural language concepts. So, you don't even need spoken words anymore. You can go straight from audio files. And if the 2021 is starting to see a lot more advances in NLP that go, beyond toddler stage to the next level of development, maybe preschool, where you show a child a picture and ask them to write a story about the picture, or you tell them a story and tell them to draw a picture based on the story. These mixed mode methods are starting to become state of the art, and that's following on the training methods that we use for humans. And I think that's going to be some of the cutting edge for 2021.
Ina's come back with another question. I think you've caused a bit of inspiration here. Thank you so much for your question. With all new model packages coming out, would you agree with claims that data scientists will be obsolete as a profession in a few years, being replaced by citizen data analysts instead? Now, I'm definitely of this backing, except I think, in my personal opinion, I've written about this in the past, that I think the data scientist will move to SaaS companies, because I see more and more business leaders struggle with communication issues and think like, oh, you know what, I'm not going to talk to my data science team. I'm just going to, buy this software, which has a simple button that'll do exactly what I would have asked my data scientist to do. What are your thoughts?
Pursue that route at your peril. If you don't know what the model's doing, you don't know when the model's wrong. And you can have a very good model that passes all of your tests in sample and by random luck performs very well on an out of sample data set that just happens to match its expectations. But then you feed it real well out of sample data and it does very poorly. Or you get a model that has a 99% accuracy in sample and maybe it drops to 95 out of sample and you think that's good enough, but you don't really get what's going on. And you have a look at the parameters and they're really large, but hey, what does that mean? I don't understand. Yeah, 95, 99, close enough, let's go with that. Yeah, you can end up with something that's inherently broken, but at first appearance looks very good. So I think there'll be a few disasters that will hopefully prevent that from happening. I think data scientists will always have a role, but maybe it is, at a higher level and, servicing the, building the tools that others use rather than running the full pipeline themselves.
Yeah, I just mentioned
if I may add something. Go ahead, Mark.
Go ahead, Arturo.
No, go ahead, Mark.
Oh, he's put himself on
really
mute.
quickly. Sorry, just really quickly. I work with a firm of consultants that were very used to data analytics, right? So Tableau, Power BI, Click, all that kind of fun stuff. And all of a sudden they were sold on, hey, you should resell Data Robot. It's this nice thing, black box. You can plug it over your data. It comes up with all these kind of models. The interesting thing was they would produce some analysis and they go, hey, look, we did this forecast, we did this time series. And they don't understand the fundamentals of you can only do certain types of time series when it's non-stationary versus stationary data. And just some of the other checks and balances, they were just using it blindly. So it was like giving a machine gun to a toddler, potentially coming up with insights for a business, making decisions on the back of that could be very detrimental. So very good point there. I think it's a higher level of data scientists that's coming. That was my point, Arturo.
And all I wanted to say is that the term data scientist and data analyst are interchanged, I think, quite often, and it's because it's a gray zone in certain scenarios. And one of the most important things of whatever we call this individual is not only to understand how to fit the models, but it's to understand what the model is not telling you. So it's kind of figuring out what that unknown actually is. And one of the biggest problems with using models nowadays is that they fit data really, really well, a little bit too well. So it's very easy to make wrong inferences, which could be devastating because typically these models, especially in finance, when they get it wrong, is not in the standard scenario, it's in the non-standard scenario. And that's when it hurts the most. So yeah, that understanding of what the model is telling you in relation to your data specifically, and also in relation to the risks that you're actually carrying is super, super important. That can't be outsourced in a simple way.
So I'm going to move on to Richard's question. Again, thank you so much, Richard, for asking your second question. Berowne, you hinted at the problem of noise to signal on Medium. Have you had any experience in identifying coordinated social media messaging with the aim of moving the market? This has happened with old media, with commentators taking a position, knowing that their comments would move the market tomorrow. I think we spoke very briefly on the GameStop saga and various cryptocurrency tokens. Have you ever had any experience in identifying those, I guess, before the runs happen?
No, I haven't been looking to do that, but it is something that I think you would need an NLP engine to help with, because the amount of text that you could potentially be looking through is huge. And, if you're looking for a Reddit post or something that a new entrant posts that causes a buzz, but while that's happening, it's not hit 1,000 reads yet. So you don't know that that's necessarily the most followed piece of news for the day yet. So you're not looking at it on your short list, but if you've got an NLP model that can scan the full hierarchy and pick up these nascent signals before they get popular, I think that could be a definite advantage, either from a risk point of view or a trading point of view. And we've also heard about some models using Twitter and looking at the followers and the hierarchy, trying to identify which posts cause price anomalies and following those back to their original posters and then following those original posts. So there's definitely a network effect that could be played out. I haven't done much machine learning using network topographies, but I think there's definite scope for that type of analysis to be done.
That's interesting. I guess you may run into issues if there's an anonymous poster which creates new accounts to stop people from trying to automate their messaging and turn into signals, because then you kind of run out of history very quickly.
Yeah, but a lot of people do this for notoriety, and so they want their ego
disincentivized to do that, I guess, right?
Yeah, exactly.
So I've got one more question that Mark, Arturo, and I have been discussing to ask you. How hard is it to break into NLP? I guess there are lots of aspiring data analysts and data scientists that are following down the numeric route and looking at time series or forecasting, things like that. And then you glance even at NLP and it's intimidating. How difficult did you find it to pick up?
Yeah, so I came from a bit of a background of quantitative finance and always been interested in computing and engineering. It's trivial. You can run an NLP model with 7 lines of code, and that will give you sentiment scores on headlines. And then you can buy the best headlines and sell the worst headlines, and you got yourself a trading model. How
difficult was that to say?
It's not hard to do well, but it's hard to do with excellence. I think if you wanted to outperform with these kind of models, because this is so easy now, news reading should be pretty much arbitraged away, as people have been questioning, because it is so easy. You can buy the sentiment scores already calculated from Bloomberg and FactSet and Reuters and all the other vendors you can think of. And they like Bloomberg were boasting that they score their headlines in a millisecond. So obviously they're targeted to hedge funds. It's not hard to do a good job at NLP now, but if you are dealing with something like finance where you have a subtly different use of language that matters, then you need some expertise and some understanding of what the models do with language to know where they might do it wrong, to know that you need to fix that. And you might make 1% improvement in the model score, or you might make 10% improvement and a meaningful impact on the alpha of the portfolio. But you can get started very easily and then build on that. and improve it. That's what I'd say.
Looking at that code, perhaps maybe the question isn't relevant for that code, but where does the tweaking of the models actually happen?
This code would tweak. If you fed this code financial headlines exclusively, rather than sports scores and so on, this model.fit will modify the parameters inside the neural net and refine them subtly to train them. Now you can model.fit, put a comma at the end and pass it extra parameters like how fast to change, the gradients and the learning rates, and how many thousands to train per batch, and all of those kind of hyperparameters. But essentially that code will fine tune the model. And then once that model.fit has been done, model.predict will use the fine tuned model that's been trained for your data set problem. So yeah, it's not that hard at all. As long as you've got the hardest part actually is getting the labeled data. Like we had, was it 4,000, 5,000 labeled data samples that we were training, and we got pretty good results that matched human level. Building a bigger data set would definitely help.
I recall again something that my wife told me about her time at the Australian, about certain companies releasing financial reports and having to dig through them to find the real story. And it's often the real story was why people read the Australian and the AFR and the such. It's not necessarily the headline figure that, such and such bank makes 20 million. It's no, they had to write off this many assets. They had to fire this many staff. But that's of course buried in, page 90 of the index.
Yeah.
So how does NLP perform to capture the real news, I guess, of a financial report?
Yeah, well, that's something I've been working on recently, is going beyond the headlines. So our new model that we're working on has come so far, and you saw earlier on those slides that some of the models were taking less than a second to score 1,000 headlines. So you can feed full text articles and get sentiment scores for that in less than a second. And if you scale up the compute or optimize the pipeline, it could be even faster. I'd paid no attention to actually optimizing those results in terms of speed. So yeah, full text is becoming possible. A lot of these models have memory constraints, and so they top out at 100 or 500 words. I think newspapers target 100-word paragraphs and maybe go to 200 at the extreme. So 200 words is probably enough for a concept. If they're written well, you try and put a concept in a paragraph and move on. But then full article is something that's becoming feasible. So what we're doing at the moment is just chunking in 100-word chunks and scoring those 100 words. But one of the other models, like Longformer, is designed to merge the attention across concepts and into longer paragraphs and keep track of attention in a more subtle way, but apply it across the whole document. So those document level learning models will potentially help with that kind of thing as well. That's a roundabout answer. Hopefully it covered enough.
No, that was great. I'm ashamed to say that I think I'm out of questions. Mark, is there anything else that you want to talk about with Berowne?
I was just going to say, we've got one more question come through, so I might take a look at that. But I did just mention in the chat that if people are interested in this kind of stuff, make sure you follow DSAI either on our main page, dsai.org.au, or on LinkedIn, which is easy. But James, there's another question that's
it's just popped up now. Yep. Sorry, Berowne, one more question. For regulatory heavy areas of banks, how many machine learning / deep learning algorithms can penetrate into convincing manner for regulators? What is the current state? What about other areas of AI apart from machine learning? Do we see any implementation into other fields? For example, adversarial searches, first order logic. I'm going to give my thoughts here from reading a few articles on risk.net about the Fed looking to regulate AI. Now, I know we're far from it, but that is a interesting plight. I'm not sure how they would do it. And I think, if I'm being perfectly honest, the lack of regulation and the lack of statistical proof that you can give a regulator if you use something like a neural net is probably why people don't use them. But for example, hedge fund managers and other portfolio managers would look to use AI to make profits, just not a bank to calculate capital. Where do you see this all going?
Yeah, I'm not part of the model review, but I do know we have one for measuring capital and so on. So there are people that pay attention to that type of thing. I'm in research. None of my models are trading portfolios, so I don't need to pay too much attention to that. But if we do go up a level to the structured products and trading desk, all of our models get much higher level of vetting and review. So it's something that definitely needs to be done, both from an investment fiduciary duty kind of point of view, but also for peace of mind. You want to make sure that the model's doing what you think it is. So I think some kind of regulation is necessary. I think Australia is probably in a better place than other markets because we do have the beneficial owner tag on all the trades that are getting executed through DMA. So I think the regulators have got a greater hope of picking out problematic trading algorithms using market impact measures. I don't think you necessarily need to interpret and understand the code behind the machine learning model. If you're a regulator, I think exploring the effects of those trades is probably sufficient. But I don't know how other markets are going to do that without knowing which trades were executed by whom.
Yeah, I think it's sorry that I jump in. I think that's a slippery slope, simply because effectively what you want to regulate is the risk, and you want to regulate the process that leads to a specific outcome. And if you start regulating AI in general, then you kind of miss out on the plot. I remember that when trading systematically commodity futures, it actually didn't fall under any. It didn't fall under the classification of an algorithm the way in which algorithms were thought of as dangerous, because they were being traded through the same methodologies and the same risk budgets as other human beings were trading. So I couldn't, if one of the algorithms, for example, screwed up and tried to put through an order that was too big, it was just not allowed. So I think, again, the problem here is more about understanding what is the workflow that is being followed in order to make a decision, and what the impact of that decision is coming from a human being or from an algorithm, instead of just trying to understand what the algorithm itself is actually trying to do. Because in many cases, most people don't really understand that, actually.
Yeah, I think a lot of the trading markets are putting on, you know, the brakes when markets move too far, and I think that's a sensible thing to do, because, you know, the algorithms especially often aren't written for those tail events. They don't necessarily have any constraint. Oh, market's gone down 50%. Well, I better sell and follow it down. So, you know, shutting markets down when those kind of extreme events happen, I think gives everybody pause and time to address their risk situation, and, you know, maybe put the brakes on a few models and reset. So I think that's probably something that we'll see a little bit more often, is more markets putting, you know, 10, 20, 50% limits on volatility.
I'm going to recall again when I was training the prop desk, our little, you know, my close friends and I, all trading in the same venue, or the same office, I should say. We made a rule to never hold our positions while Mario Draghi was speaking, because the context was so ambiguous. You know, he'll give these talks like the Federal Reserve, or even like you know, our current Reserve Bank. You know, Philip Lowe opens his mouth and it could mean literally anything, and people try to decipher little tiny words that they dropped in anyway. But when Mario Draghi speaks, the whole market, you know, collapses. But yeah, that's it's interesting to say that. We've got one larrikin that's decided to make a comment here by the name of Mark Monfort, that we're recalled to the time when the congressional hearings happened for Facebook, and regulation of data confidentiality and privacy and things like that. And there were many clips circulated online about how little the congressman knew about the internet, let alone Facebook. Do you think that there is a risk that will fall into the same trap with trying to regulate AI?
Yeah, I think so. I think, you know, if people don't know what they're doing and they don't pay regulators enough to hire and attract smart regulators and smart people into those positions, they'll end up regulating the wrong thing. They'll not know what they're doing, and so they'll ask the corporations that they're regulating what they should do, and then of course they'll be steered down the path of building laws that don't do anything restrictive anyway. So yeah, I think there is a risk to regulation when it's not thought out well and not applied well. Saying that, you know, maybe something does need to be done, but I think I don't know that there needs to be a distinction between AI trading regulation and human trading regulation. I think the regulation should be on the outcome.
Yeah, I guess that's
Exactly,
why.
like goal.
Oh, sorry, go ahead, Mark.
I was going to say, I think they call that goal-based kind of regulation in other areas, like whether it's stuff that we're doing in ESG, finance, energy markets, even healthcare. It's the same kind of thing. It should really be based on the outcome. So wholeheartedly agree with you there on that. Sorry, back to you, James. And we'll probably wrap up soon, considering it's 7:15. And appreciate the questions, everyone. This has been amazing.
Yeah, thank you once again, Berowne, for your patience and for you know, sharing your knowledge with us and sharing your expertise. I'm sure everyone on this call and everyone who watches the recording as well is going to be highly appreciative of your stories and your knowledge. The last thing I was gonna say, just to close that off, is I guess that's why you know, speeding tickets work so well on the exchanges, both to shut down the trading and also shut down the traders. Kind of that, to your idea, Mark, of a goal-based regulation that don't really care how you did it, you broke the rules, that's it, stop doing that thing. And as long as AI kind of, you know, stays in the same lane as traditional market concepts, then I guess I'm going to have to agree with you, Berowne, that I think the way the technology moves should go wherever it needs to go, but you know, people should still continue trade in an equitable way, and not kind of step on each other's toes or whatever, try to manipulate markets or corner them. Although, you know, we could go down a different path because we've seen many stories of people failing to do that well. I think I'll tie that off there. Any other questions?
Seems like we're all good for now. So really appreciate it, James, for emceeing, Arturo, for introducing a bit more about what we're doing. We're looking to do more of these talks. This was supposed to be live. I'm not sure if some of the people that have signed up here saw the early, whether you came through Sydney Machine Learning or DSAI meetup groups. We were looking to do a lot more in person, and we're supposed to be at Microsoft Reactor at York Street. So didn't work out this time. We'll see, fingers crossed, how COVID plays out over the next couple of months. Hopefully it won't be a see you in 2022. Hopefully we'll see each other sooner than that. But Berowne, you know, I've spoken at your conferences. I've seen you speak at conferences as well. You've been amazing. So thank you very much for all of this. If people want to follow along, are they all good to follow you on LinkedIn and, you know, see some of your great work?
Yeah, so they can follow along on LinkedIn, and try and keep track of some of the more interesting releases as they come out. I think today I posted about a Kaggle competition, a $100,000 prize pool for risk forecasting. So, you know, bring that on. You know, encourage all the students that hassle me to give that a go, because that is an excellent way to share ideas and build skills and get yourself exposure. I also want to say, you know, big thanks to James, Mark, and Arturo for hosting. And I also want to point out, of course, that while I work at JP Morgan, all the opinions I've said are mine. Thanks again.
Beautiful. Thank you so much.
We'll put the full disclosures at the bottom of this, you know, as you see on Ausbiz, as you see on Sky News, or all of the above. We'll do that. And to remind everyone, this is recorded. As soon as we process this, removed all the bad words, NLP, jokes. No, we'll be posting this through the DSAI YouTube page, which currently has one video on there, but we are looking to grow that out. So I will share that with the meetup groups if you came through there, and please stay tuned.
Thank you so much,
right,
everyone.
thanks.
Have a good evening.
Thanks, everyone.
And, have a good morning if you're on the other side of the world.
Take care. Bye.
Bye.